Imagine waking up tomorrow and discovering that your home is worth exactly what it was worth last year. No crash, no collapse, no scary headline about property values being wiped out. Most people would probably consider that good news. But what if, despite your home's value staying the same, you were actually becoming poorer every single month? That sounds impossible, but it may describe what is happening to millions of homeowners today. For years, the public has been taught to judge the housing market by one simple metric: home prices. If prices rise, the market is healthy. If prices fall, the market is in trouble. But what if there is a third scenario? What if prices don't fall very much at all, yet the housing market still creates financial pain for both homeowners and buyers? That is the possibility we are going to explore today. And by the end of this video, you'll understand why some analysts believe the biggest housing risk isn't a crash, it's a freeze. Let's start with what makes today's housing market so unusual. Unlike the period leading up to the 2008 housing crisis, many homeowners today are financially stronger. Millions locked in fixed mortgage rates during an era of historically cheap borrowing. Some secured rates near 3%, others even lower. Their monthly mortgage payments are predictable. Their credit profiles are generally stronger than the borrowers who dominated the housing market before the financial crisis. On paper, that sounds like a recipe for stability, and in many ways it is. But there is a problem. The mortgage is only one part of home ownership. Most people focus on the monthly loan payment because it is the largest expense. Yet homeowners know there are many other costs attached to owning property. Property taxes, insurance premiums, maintenance, repairs, HOA dues, utilities, landscaping, unexpected emergencies. These expenses don't care whether your mortgage is fixed. They continue rising, and in many areas, they are rising much faster than household incomes. Think about it for a moment. A homeowner who bought a house several years ago may still be paying the same mortgage amount every month, but their insurance bill may have doubled. Their property taxes may have increased. The cost of replacing a roof, repairing plumbing, or maintaining the property may have risen substantially. As a result, the total cost of ownership keeps climbing even when the mortgage remains unchanged. This creates a pressure that isn't always visible in housing statistics. Now let's talk about why this matters for the broader market. Traditionally, housing markets adjust through prices. If homes become too expensive, demand weakens. Prices eventually fall. Lower prices attract buyers. The market finds a new balance. That's how many downturns work. But today's market has a complication that didn't exist in quite the same way before. Millions of homeowners have mortgage rates that are dramatically lower than current market rates. Imagine you own a home financed at 3%. Now imagine selling that home and buying another one using a mortgage rate that is more than twice as high. Even if the new home costs roughly the same amount, your monthly payment could increase significantly. Would you move? Many homeowners have answered that question with a simple response: no. And that's exactly what's happening. Owners who might otherwise sell are staying where they are. They aren't moving because they love their house. They are staying because they love their mortgage rate. Economists sometimes refer to this as a lock-in effect. The low-rate mortgage becomes so valuable that homeowners become reluctant to give it up. At the same time, potential buyers face a different challenge. Mortgage rates remain elevated compared to the ultra-low levels seen during the pandemic era. Home prices in many regions are still historically high. The combination of the two has created an affordability problem. Many households discover that they can no longer comfortably qualify for homes that would have been affordable just a few years earlier. So buyers wait, sellers wait, and transaction volume slows. This is where the concept of a frozen housing market begins to emerge. Not a crash, not a boom, a freeze. The market still exists, homes still sell, but activity becomes increasingly constrained. And frozen markets can be surprisingly damaging. Why? Because the financial pressure doesn't disappear. It accumulates. Homeowners continue paying rising ownership costs. Buyers continue dealing with affordability challenges. The system becomes stuck between two groups whose interests no longer align. One group doesn't want to sell. The other group struggles to buy. Now let's discuss something that often gets overlooked: home equity. Many people treat home equity as a form of wealth, and in many cases that's perfectly reasonable. If your home increases in value and your mortgage balance declines, your equity grows. But there is an important distinction between paper wealth and realized wealth. Paper wealth is what appears on a statement or online estimate. Realized wealth is what remains after expenses, taxes, and transactions. Suppose a homeowner believes they have accumulated substantial equity over the last decade. That equity may look impressive. However, if ownership costs continue rising year after year, some of the financial benefit may be quietly eroded. The homeowner still owns the asset. The home still has value, but the cost of holding that asset becomes increasingly expensive. This matters especially for older homeowners. For many households approaching retirement, the family home represents one of their largest financial assets. Retirement plans often assume that home equity will play an important role in future financial security. Perhaps the homeowner plans to sell, perhaps they plan to downsize, perhaps they expect to use some of that equity to supplement retirement income, but those plans depend on market conditions. If fewer buyers qualify for homes, selling may take longer. If carrying costs remain elevated, homeowners continue spending money while they wait. If smaller homes also become expensive, downsizing may generate less financial benefit than originally expected. Again, none of this necessarily requires a housing crash. That's what makes the situation so interesting. Many people assume financial stress only appears when asset prices collapse. But history shows that prolonged stagnation can also create challenges. A market doesn't always need dramatic headlines to produce meaningful economic consequences. Sometimes the greatest pressure develops gradually, month by month, year by year, quietly. That is why affordability remains one of the most important indicators to watch. When affordability deteriorates, fewer households can participate in the market. When fewer households participate, liquidity declines. When liquidity declines, moving becomes harder. And when moving becomes harder, the housing market loses some of its flexibility. This affects first-time buyers. It affects growing families. It affects retirees. It affects workers who want to relocate for better opportunities. Housing isn't just about shelter. It's also about mobility. When housing markets freeze, mobility often suffers as well. So where does this leave us? The future of housing may depend on which side adjusts first. Will mortgage rates eventually decline enough to improve affordability? Will home prices soften enough to attract more buyers? Will incomes rise fast enough to close the gap? Or will the market remain trapped between sellers unwilling to move and buyers unable to purchase? Those are the questions investors, economists, policymakers, and homeowners are all trying to answer. One thing is clear: the housing market doesn't need to crash to create problems. A market can remain stable on the surface while important pressures build underneath. And sometimes those hidden pressures become the story that matters most. So the next time you hear someone say, housing is fine because prices haven't fallen, remember this: price is only one part of the equation. Affordability matters, ownership costs matter, mobility matters, and the ability to turn home equity into real financial security matters. The biggest housing story of the next few years may not be whether prices rise or fall. It may be whether the market can start moving again. And that could affect millions of homeowners, buyers, and retirees across the country. What do you think? Is the housing market headed for a correction, a recovery, or a prolonged freeze? Share your thoughts in the comments, and let's discuss.